Not only is the U.S. teetering on the edge of recession, but it appears we're headed full speed ahead for a stagflation economy. Inflation expectations are on the rise and consumer sentiment is falling fast. This makes for a very troubling combination that signals deeper economic strain ahead and is a self-perpetuating cycle. When people begin to expect prices to keep climbing and they feel less confident about the future, spending slows and of course financial uncertainty continues to grow. The University of Michigan released their latest consumer survey, and Americans now expect prices to jump by 7.3% over the next year. In addition to this, BlackRock's Larry Fink also expects inflation to hit 7% by summer, and at the same time, consumer sentiment plunged to new lows. The drop was due in part to the threat of new tariffs and the ripple effects of rising costs. This sharp shift in outlook has once again brought gold into the focus as a time-tested hedge against inflation and volatility. Now, one of the driving forces behind rising inflation expectations is the growing burden of tariffs. In fact, the effective tariff rate in the United States right now is 17.8%. It's the highest it's been since 1934. This concern is not just on the academic side either. Major companies are sounding alarms about the potential impact on prices. Walmart, along with more than 400 other companies in the S&P 500, have issued a major warning, and they said higher tariffs on imported goods from China could soon be passed along to the American consumers. And even after recent adjustments, many tariffs remain steep. Walmart CEO Doug McMillon said even at the reduced levels, the higher tariffs will result in higher prices. And estimates from Yale University's Tobin Center for Economic Policy suggest the impact could be very significant. Their analyst shows the average American household could face an additional $2,800 in annual costs due to these tariffs. And these aren't just short-term concerns. University of Michigan's report also revealed inflation expectations have increased over the long term as well as the short term. Joan Su, the director of University of Michigan's consumer surveys, she points out that inflation expectations influence real economic behavior in a sense that when people believe that prices will go up sharply, they often speed up their purchasing or they push for higher wages. Both of these, of course, are the very real things that lead to actual inflation. With all that said, uncertainty over trade policy continues to dominate consumers' thinking about the economy, and this shift in expectations also signals a growing disconnect between hard data like retail sales and jobs reports, and of course soft data such as consumer sentiment. Retail sales remained positive in April, and the U.S. payrolls actually rose by 177,000, and unemployment actually held very steady at a fairly historical low of 4.2%. But despite all this, consumers continue to express very somber views about the economy. And there was another troubling sign from the survey. The University of Michigan's May Consumer Sentiment Index dropped 30% just since December. Now, that's the second lowest level ever recorded. The main reason behind this decline is widespread anxiety about the impact of tariffs and potential job losses. 2/3 of the respondents now expect unemployment to rise in the year ahead, and that's the largest share since 2009. Perhaps most notably, this sentiment shift is not limited to lower-income Americans. We're actually seeing huge declines across the income spectrum, but most notably, it's at the top of that income distribution. And consumers are expecting a large shock to their personal finances. Many are reporting weakening incomes. Assessments of personal finances fell 10 points in early May to the lowest, again, since 2009. And meanwhile, the outlook on their future finances had dropped to the lowest on record ever. Wall Street also recognized the shift in sentiment. JP Morgan CEO Jamie Dimon recently warned against complacency in the face of mounting risks. He cited everything from inflation and credit spreads to geopolitics. And Dimon said that chances of elevated inflation and stagflation are much greater than people think. They cautioned that America's overvalued asset prices aren't accounting for the impacts of a potential downturn. Now, JP Morgan has already taken steps to prepare for possible turbulence. The bank said it added $973 million to the pile of money that it sets aside to cover bad loans. Moves like this highlight the growing concern over the economy's direction. So with inflation expectations at their highest in decades and consumer confidence near record lows, Now is a critical time to reassess your financial strategy. And if you're concerned about the overall economy, the state of the US dollar, and the direction that things are headed, I'm Mackay Block with American Hartford Gold. Give us a call today and we'll discuss how adding physical precious metals into your portfolio can give you the hedge that you're looking for.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.